S&P 4319 is where it currently sits. 4284 was the low on the day. Let's bring in somebody who suggests the S&P, in fact, could go below 4,000. Jonathan Krisnky, Chief Market Technician at BTIG. Welcome. It's good to have you on the phone. Why do you think we could breach that level?
Hey, Scott. Yeah, well, so we've been pretty consistent on your show the last few weeks. There's really two main reasons. One is the internal breadth of the market, and the other is credit spreads. And we haven't really seen much improvement in either of those. And if you look at percentage of stocks in the S&P above the 200-day, it's been pretty consistently below 55% over the last 4 or 5 weeks. And that's really a level that, you know, if you stay below there, traditionally, you actually see things get a bit worse before they get better. So that's one thing we're watching. And then credit spreads, you know, even as the S&P has kind of chopped around in a range the last week or so, credit spreads have continued to widen out. And then finally, throw on the surge in commodity prices. We're seeing multi-month moves up in commodities we haven't seen in 30 years. And so, you know, they obviously are benefiting certain parts of the market, which is why we've seen moves up in the commodity stocks. But, you know, ultimately that's probably going to have some ramifications as well.
Well, let me ask you this. What if, and I've given Jim Lebenthal enough grief today, and I don't mean to do it so overtly. I think it's worthy of questioning calls to the nature of how aggressive his is. What if he's right? What if there is a solution in a couple of weeks to use his time frame in Ukraine? Does that change the calculus for stocks wholeheartedly?
We don't think so. I mean, if you look internally, you know, and we've talked about this before, but there's a lot of the market peaked over a year ago, and then a lot more of the market peaked in November, December, January before really Russia-Ukraine came to the front headline. So certainly it could give a near-term pop. You know, also the commodity moves, this is not something that just started 2 weeks ago. I mean, and you look across soft commodities, wheat, corn, soybeans, you know, aluminum, even lumber. Remember a year ago, lumber, people were freaking out about lumber prices. It's almost back to where it was at the highs, and you don't hear many people talking about that. So we think it's bigger than just Russia-Ukraine at this point.
What's your base case? Is your base case call below 4,000 on the S&P, or is it more optimistic than that? It's just certain things could drag it below 4.
Yeah, I think, you know, that's kind of a range of a target that we think makes sense. And just looking at some long-term perspective, we've talked about this before. The 200-week moving average on the S&P is down around 3,400. We're still 27% above that. You know, historically, 30% or higher is pretty rare, and so we're still pretty far away from that from a long-term perspective. But I think the bigger thing we're looking for is that kind of broad-based capitulation. And one of the measures for that is looking at advancing declining volume on a given day. We have yet to see a 90% downside volume day at all this year, which is very rare for the type of decline we've seen in the S&P. If you go back 25 years, the only other time we've seen a 10% drawdown without a 90% downside day was in 1999. So pretty much every other time you're in this type of drawdown, you get some sort of capitulatory selling event. And we think that's missing largely because you've just had this constant rotation among sectors. But ultimately, we think, you know, everything will go down. And that's when you get the capitulation.
All right. We'll see what happens, obviously. Have a good weekend. Jonathan Krisnky, thanks for joining us. BTIG Chief Market Technician.